Okay, students, we're back. Now, this is where we left off, and I ended by pointing out that, again, what the aging of accounts receivable method does is we calculate what balance do we need as an ending balance in the allowance for doubtful accounts. In other words, how much of our accounts receivable balance do we think will ultimately prove uncollectible? Now, by aging your accounts receivable and then treating each aging category separately with its own estimated percentage, we get the best possible estimate of what will prove uncollectible. So we need a $15,500 balance. Right up here, I didn't go up far enough a while ago, but here is our account. And it had a beginning balance, or right here, it had an ending balance from the previous period of 14,200. So again, in the margin down here, here's our balance that we have. There's the balance we need. So we need a credit of $1,300. So we're going to debit bad debt expense, credit the allowance for doubtful accounts for that $1,300, and that gets us to the balance we need. Now again, this is what we refer to as a plug number. We just plug that. We say, how much more do we need to get us there? Now, what if the allowance account had a $200 debit balance? Well, the answer is then we would have needed a credit for $15,700 to get us to this ending balance of a credit balance of $15,500. So if the allowance account has a credit balance, then we subtract to get the needed adjustment. If the allowance account has a debit balance, then we add the debit to the needed ending balance to get the size of the adjustment. Now, your book talks about that. Somewhere right here, debit balance and plus. You can read all of that. Now, when an account proves uncollectible, what are we going to do? Well, we're going to debit the allowance to reduce it and credit accounts receivable. Right here, when we recognize this $1,300 of estimated additional doubtful accounts, we're recognizing bad debt expense at that point. Okay, revising estimates with an estimate. If we, let's say, we wind up with too much in the allowance account and we decide some of these numbers are too big. Well, what do? Well, we revise those in the next period. We don't go back and restate anything from previous periods. That's a change of estimate, and changes of estimate are handled in the current period and in future periods. No revision of previous numbers, no revision of previously issued financial statements. Okay, then account recoveries. Now, every once in a while, we write off an account as a bad debt, and then at some later point, we actually collect that. You know, the customer's store was empty. We send them bills. They came back. We went over and looked in the windows. The place was empty, and or maybe we went and the place had been burned down. It had burned to the ground. And so we write it off as a bad debt. So here we have one where they had written off an $800 balance as uncollectible. So we go and see that their store was burned down. There's no one there. and we write it off. Well, at some point later, they collect their insurance money and they come in and want to make good and settle their account. So they come in and pay us the $800. What do? Well, the first thing we do is reverse that entry where we wrote off their account receivable. So we debit accounts receivable and credit allowance for doubtful accounts. So that puts the $800 account back on the books. It also puts that $800 balance back in on the allowance for doubtful accounts. Now, what we're saying is we set up that allowance for doubtful accounts because we knew that some people would not pay. When we wrote this account off, we said, okay, we have identified an account for $800 that's one of those that isn't going to pay. So we debited the allowance, credited accounts receivable. Now we come in and find out indeed they are going to pay. So we say, oops, we made a mistake in that prior entry. We thought this person wasn't going to pay, but now we know they are. So we need to undo what we did in writing them off. So we're going to debit accounts receivable, credit the allowance for doubtful accounts. Then we debit cash, credit accounts receivable. Okay, so that is recording their payment. Now, under alternate methods here, alternative methods, they talk about the direct write-off method. The direct write-off method is the opposite of the allowance method. With the direct write-off method, we don't set up an allowance. We just write off an account receivable that proves uncollectible by debiting bad debt expense, crediting accounts receivable. Now, you may say, gee, that seems simple. It is, but it violates GAAP. The reason, generally accepted accounting principles, the reason it violates GAAP is it violates the expense recognition principle or matching principle. Now, again, the matching principle, or also referred to as the expense recognition principle, says we match expenses with the revenue they help generate. So if we are writing off as uncollectible bad debts that occurred in a where the sales occurred in period 1 and we write it off in period 2, we're not matching revenue and expense. So that method's not allowed by GAAP. It's in the supplement of the chapter. I'm not going to cover that. I'm not going to give you homework problems on it. We're going to focus on the allowance method because it is required by GAAP. Okay, let's go over some homework problems. So we will start here with mini exercise 8.3. Reporting accounts receivable and recording write-offs using the allowance method. And on December 31st, 2017, Extreme Fitness has adjusted balances of $800,000 in accounts receivable and $55,000 in allowance for doubtful accounts. On January 2nd, 2018, company learns that certain customer accounts are not collectible. So management authorizes a write-off of those accounts totaling $10,000. So A, show how the company would have reported its accounts receivable on December 31st, 2017. As of that date, what amount did Extreme Fitness expect to collect? Well, they would have shown the balance in accounts receivable of $800,000. They would have showed a reduction of that by the allowance for doubtful accounts of $55,000 and net accounts receivable of $745,000. Now, there we see that. Okay. So what would they have shown on the balance sheet? It would have shown accounts receivable net of $745,000, and that's the amount they expected to collect. Okay, now B part, prepare the journal entry to write off the accounts on January 2nd, 2018. So that's this $10,000 of accounts we're going to write off. So we're going to debit the allowance account, credit accounts receivable for that $10,000. So debit allowance for doubtful accounts, credit accounts receivable for $10,000. Excuse me. The C part, assuming no other transactions occurred between December 31 and January 3rd, show how Extreme Fitness would have reported its accounts receivable on January 3rd, 2018. As of that date, how much did they expect to collect? Has that changed from December 31? Well, the answer is no, it has not changed. Now we have reduced accounts receivable by $10,000. So accounts receivable has gone from $800,000 to $790,000. We've reduced the allowance account by $10,000. So it's gone from $55,000 to $45,000. But net accounts receivable is still $745,000. And that's still the amount we expect to collect. All right, at this point I would ask any questions, but we're just going to move on to the next one. So here is the question. Let's go a bit further with the example from M83. Assume that on February 2nd, January 2018, Extreme Fitness received a payment of $500 from one of the customers whose account balance had been written off. Prepare the journal entries to record this transaction. So there we have $500 collection of one of these accounts, this $10,000 of accounts that were written off. So the first thing we need to do is reinstate that balance by reversing the writing off of it. So we're going to debit accounts receivable, credit the allowance for $500. That's reinstating the account and putting the money back into, or the balance back into accounts into accounts receivable and the allowance account. And then we're going to debit cash for $500, credit accounts receivable to record the payment. Next, we have mini exercise 8.5. Prepare journal entries for each transaction listed. So at the end of June, bad debt expense is estimated to be $14,000. So that's our estimated bad debt expense. So we're going to debit bad debt expense to record that. Credit the allowance account for the $14,000. Okay. There we have the debit to the bad debt expense, credit to the allowance for $14,000. Then the second part of that, in July, customer balances are written off in the amount of $7,000. So we're writing off customer balances. We need to credit accounts receivable for $7,000, debit the allowance for $7,000. So there we have debit allowance for doubtful accounts, $7,000, credit accounts receivable for $7,000. Okay, our time for this video is just about up, so I'm going to stop it and pick up with exercise 8-1 on the next video.